What is a good ROI on a house flip? By the end of this video, you're going to understand what's a good ROI to aim for and how to protect your profit from getting eaten away. You ever wonder how much return you should be making on a flip? A good ROI can make or break your flipping career. I'm going to show you how we set our targets and why. This video breaks down the difference between an okay flip and one that's really worth your time. Okay, let's talk about ROI versus profit margin. Here's where they're different. The ROI stands for return on investment. Assuming you put money in the project, how much return did you get on your investment? It's a lot clearer in something like the stock market. If you put $100,000 in the stock market and you earn $10,000, your ROI, or your return on investment, is 10%. Very simple, very clean cut. However, when you deal with real estate, you may not put your own money in the deal. So, in theory, if you do this right as a real estate investor the way that I teach, you should have very little, if any, of your own money in the deal, and therefore your ROI, or return on investment, is infinite. The cool part is, if you did put some money in, imagine the return on your investment of capital. Let's say, for instance, that you did a deal where you borrowed $90,000 to get the deal done, and you put in $10,000 of your own money. Let's just say it was a $100,000 investment. But again, $10,000 was your money, $90,000 was from a hard money lender, a private lender, or creative financing. If you have $10,000 in the deal and you flip that house and make $50,000, if you invested $10,000 and you made $50,000, it's a 500% ROI. Only in real estate can you make this kind of ROI on your investments. Now there's profit margin. Profit margin is how much profit did you make on the deal when all was said and done. In other words, if you have a house that sells for $250,000 and you make a $50,000 profit, well, then your profit margin was a 20% return. So 20% profit margin on a $250,000 house is $50,000. So they are different ways to calculate your profit. I'm going to strongly suggest that you focus on profit margin over ROI. And here's why. On any flip, you, again, may not put a lot of your own money in. In the early days of our flipping career, Amber and I used to target a $20,000 profit. Not a margin, just a number. That was a mistake. We got lucky because at the time, the value of the houses was around a $150,000 ARV. So we were making $20,000 to $30,000 in profit per house, which was around a 20% margin. We just happened to get lucky at that. It wasn't until my older brother looked at me and said, "You should probably think about profit margins." And I said, "What do you mean?" He said, "If you focus on a profit margin, you should protect yourself on your downside in case something happens. Because as house numbers got bigger, that $20,000 doesn't work anymore." You see, if I'm trying to target a $20,000 profit, but I'm risking $500,000 on a flip, that's a good way to lose money. One mistake or one extra month of holding time can totally eat up a $20,000 potential profit in a flip. So it's better on a $500,000 house to focus on a 20% margin or a $100,000 profit. It's not just so you make more money, it's so you protect your downside. Because you're going to have mistakes, you're going to have oops, you're going to have hiccups that happen in the business. When those happen, you want to make sure you're protected, and that's why a margin helps you stay protected. Now, there are higher ARV areas of the country. Let's face it, Southern California, where you're buying a 2-bedroom home for $1 million, or even places like Denver, Colorado, where people are flipping houses for $1 million, $1.5 million. You're not going to run a 20% profit margin there. If you do, boom, you are crushing it. Realistically, in those markets, for the past 2 decades, they've been running about an 8% to 10% margin. That's okay if the ARV on the house number is larger. In other words, if you're selling a house for $1 million, but you're targeting an 8% profit margin, that's an $80,000 profit. Still a great deal, right? But you want to cover yourself because the numbers you're dealing with are greater. So keep that in mind. The percentage that you determine to work in is going to be directly related to in the area of the country that you are trying to flip houses in and the type of houses you're flipping houses in as well. So what eats into your profit margin or your ROI if you choose to track by ROI? What really kills most people is what I call the silent killer of real estate deals. We have a video on our channel totally dedicated to talking about the silent killer of real estate deals. Feel free to check it out. But the silent killers are holding costs. When you buy a piece of property, just for the privilege of owning that property, you're going to have interest payments. You're going to have insurance payments. You're going to have taxes. You're going to have utilities. You're going to have maintenance. All these things are what you get to have as the owner of that property. You see, those costs accrue or get paid every single month. And every dollar you pay in holding costs comes directly out of your profit. You have to allot a certain amount, that's just normal business. But at some point, it can become excessive if you're not being a good manager or a good steward of your time on a flip. They will directly impact how much money you make on a flip. So I recommend that you manage those like a boss. Think of it like this. The average flip, maybe a $300,000 flip, is about $200 to $300 per day in holding costs. So imagine that every morning I came to your house, knocked on the door and said, "Good morning, you owe me $200. The first couple of days you'd be like, "Great, I own a house. Great, I'm flipping a house." By the 7th or 10th day or 30th day, you'd be like, "Stop coming to my door." I knock on the door and you say, "It's Sunday morning." I say, "I know, pay me." "Glenn, it's Christmas, pay me. It's Easter, pay me." That's what holding costs are. Every single day. If you treated it like that, instead of ignoring it until the end, you would be much different and your profit margin would be much different at the end of the job. Most people ignore holding costs because they accrue and you're not paying them every month, like taxes. And all of a sudden they say, "I owned that house for a year. I just had to pay $7,000 in tax at the closing table. I wasn't expecting that." And your profit margin shrinks just like that. You know, along in this calculation, time and effort, they matter too. Your time is worth money. When you get paid a profit, that's going to be your pay at the end of the job. How much did you make per hour? For the risk you took, how much did you make? You see, to know if your business is healthy, ask yourself, if I had to pay someone like me to do this job, would I still make a profit? If you don't really have a healthy business yet. I want you to strive towards having enough margin in every job that you could hire out the things that you're doing, even if that's project management. Because the higher the margin you have on every deal, the better chance you can hire somebody else to come in and you can do multiple deals. And you could spend your time where you should spend it looking for the next deal. Because you make the most money per hour by negotiating and finding the next deal, not by managing what time the bathtub gets put in or the tile gets completed. So if you can hire other people to do the work that's less than what you should be doing, you'll start to grow a business that has real, true profit margins. At the end of the day, an overall flipping business should run about a 20% profit margin with the owner removed. And that's about where we run our business. I am removed from my business and it runs about a 20% profit margin. If somebody tells you they're running a 50 or an 80% profit margin, I will guarantee you that owner is working in that business and wearing multiple hats and doing multiple roles in the business. You're kidding yourself if you're an owner of a business and you think you're making margin, but if you were to step out and hire someone to come in there, your business doesn't make any money. You just made a fancy job for yourself, so all you've done. You want to make sure you have tools and habits in place and also spreadsheets in place to track everything. A lot of times costs will come in, sometimes weeks or months after you close a deal. I can remember sometimes having contractors send invoices for $1,000 a year and a half after we completed a flip. Those tax records were long cleaned out. We had to have a long discussion about how we were not going to pay that bill because it was a year and a half later. We ended up negotiating it out, but I can tell you something, there are bills that come in later, utility bills and security deposits and overpayments on insurance and underpayments on insurance, and all these things will show up later on. And it's important to know all those figures at the end of the job, because for you to calculate your ROI or return on investment or profit margin, you have to have all the numbers. Once you have all the numbers, it's very simple to say, okay, here's the two ways to calculate this. Number one, what is my net profit? What did I sell the house for? Then subtract every expense, including your CapEx or your capital expenditure. How much did you pay for the house? How much did you put into the house? How much were all your expenses? At the end of the day, what is your true net profit? You're going to divide the profit amount by the sale price of the house. That will give you your profit margin. And that's why you know what your profit margin is in a percentage. The next one's going to be your ROI or return on investment. That's where it gets interesting. How much did you put in? Not your time, but how much of your own money did you put in the deal? You can calculate that very simply by saying, what is my profit? What did I put in? Look at those two numbers and decide what your return on your investment was. Again, if your profit is greater than the number you put in, that's over 100% return, and that's where you want to be as a house flipper. So do you want to lock in a good profit margin or ROI? Well, guess what? It all starts with the numbers. In this next video, I'm going to break down exactly how you should figure out how much you should pay for a house to profit the most you can possibly profit. And that's going to be by determining your ARV, your after repair value, your MAO, your maximum allowable offer, and your repair costs. With those three things, you can determine how much you should pay for a house, and you can determine your profitability right up front. How do we know this? From 20 years of building this machine that we still use to flip over 100 houses a year, and I want you to learn directly from me. So I made this video for you. Go check it out, and if it's not there for some reason, look in the description. There'll be a link there. It's my gift to you. Hope you enjoy it.